So, like I said, like I said, this is um low im- very yes, low impact. This is high impact, and this is medium impact. You understand? And the low impact, it does what? The low impact does not move the market, which are the one that are yellow in color. You understand? And this one, they are medium impact. They move the market sometimes, but they don't actually move the market. And these are red, high impact expected. You understand? These news are the news that move the market. So because news is just what the institutions use to push the market to any place they want the market to go to. You understand? But I don't use this yellow, because this yellow is a low impact and probably do not move it doesn't ever move the market. You understand? So first, what I check every day is the news and this finvix, because these companies are the top first 500 companies in the United States. You understand? And from the color of the stocks or the assets, I can actually have something like a view of where this market will be going to. You understand? So I just use this as color calibration, something like that. You understand? So we've talked about our news and our what we use to check uh, the performance of S&P 500. You understand? If you want to trade S&P 500, do you understand? So, and I don't know. You know about the sessions now, right? Do you know about like the sessions that? Okay, okay. So sessions. See, forex is all about discipline. You know, and it is always good for a trader to know when or at which time he or she wants to trade. You understand? Like, why I like forex is because it's just discipline. You can't say that you want to trade Asia session. Some people actually do trade all sessions. First, there are three sessions. Some people say four, but me, there are three sessions. There are three forex sessions. And you know that the people that always seize the day first are the Asians. Something like New Zealand, Australia, they used to see the every day first. So if the Asians, like New Zealand, Australia, China, and all of those, South Korea, so if they see the market first, if they see the day first, that means they will be seeing the market first. You understand? Because something like Japan is a country that produces automobiles and so many other electronic these things. So they do business almost all the time, from continent to continent, from morning till night, from morning till night. So if a country like Japan is making businesses every time, you will see that like their banks sort of will almost be awake and functioning from their own morning to their afternoon. You understand? Because the Asians and these things, they see the day first. So now, if 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 they are seeing the day first, that means their banks and their financial institutions, if maybe for example they open at I think they open around 8 a.m., but in our time, I think that would be around 11 p.m. You understand? That's 11 p.m. GMT. You understand? So now they will be seeing every performance of the market first. So now when Asians are closing, or like they are closing their trade for the day in the afternoon, then they come into London session. It is called London session because London is actually one of the top economic hubs in Europe. You understand? And that is why, and there are also very big financial countries in Europe, some like France, Switzerland, Germany. You understand? So, and all these countries are kind of 1 hour ahead of London. You understand? So, and they are 1 hour ahead of London. So let's say now, for example, if London is about 6 a.m., those countries will be 7 a.m. You understand? So now the economic banks, the financial institutions in Europe opens at 7 a.m., which is 6 a.m. on London. So now when it is 8 a.m. in other financial top European financial institutions, when it is 8 a.m., when it is 9 a.m. there, you understand, it will be 8 a.m. in London. You understand? So now the normal and the main London session, which is the European session, opens at 8 a.m. London time. You understand? So now when it opens, Asians are still in the afternoon. You understand? So now some traders now will be trading from morning, from night to morning of London. You understand? Then they will start trading London session. Then from London session, around 12 p.m. London time, that around 11:30 p.m. London time, which is also Nigerian time and other time, that's in our GMT. You know, the traders always go to break at around 11:30 London time or Nigerian time, depending on where you are. You know, so now why there was a book I was reading about McDouglas. So McDouglas, he wrote Trading in the Zone. So he said that when he was working at the floor at the Chicago Board of Exchange, that they wanted to go for a lunch break at 11:30, and there was a support, something like a support here. You know, there was a support here in the market, you know, that the market would probably respect again, you know. So now, but when the market came down here, let's say this was a support. Let's say this is a support. And the market bounced one, two, and we were expecting maybe probably another bounce, you know, something like that. But now there were no traders at the Chicago Board of Exchange to hold these supports again, because they went to lunch, and these supports now would now break like this. They will not break this zone, and probably they were traders that were waiting to trade that support. You know, but because the traders that we are trading, you know, like the institutions, were not available at that time, they broke the support. You understand? Because it is actually money. It is money that moves the market, and it is money that holds support and resistance and all of those things. So do you understand what I said here now? So now you need to know your sessions. Then from 11:30, most institutions or most traders go for lunch break. That's 11:30 London time or GMT. You understand? Then from 12:30 GMT, 1, you'll be getting into New York. Now, Asia traders are going to bed because London is closing. Because some of them will trade from Asia to London. You understand? Do you understand? Yes. So now, around 12:30, 1 o'clock p.m., some traders that are trading London session, London will be getting into New York, it will be turning to New York opening. You understand? So now, New York opening, New York traders, the Forex time of New York starts at 3 a.m. New York time. 3 a.m. New York time, but for London, if you're trying to compare with London, but New York Forex market opens at 8 a.m. That's New York time. So opens at 8 a.m. New York time, but the New York Stock Exchange opens at 9:30. So the Forex market of New York opens first before the New York Stock Exchange. Do you understand? Yes. So now, That is what happened. So now from that 12:30 p.m. to 1:30 to 1:30 p.m. our time, that's London time, the market goes in what is called an overlapping. Overlapping is something like you are moving from London to New York. You understand? Because New York traders are waking up, and New York traders are waking up, and London traders are coming back from lunch or from break. You understand? So it is called an overlapping. So, and there is usually high liquidity there. You understand? So for example, now this is Asia session. This green shaded part is Asia session. This is London session, and this is New York session. So every trader has to always know which session you will fall into. You have to always know which session you fall into and which session you are going to trade, because the market don't always follow one pattern. Like for example, the market might be dropping in Asia session, and you might come to London session. It will change. The trend will change in London session, and in New York session it will change again. You understand? So you have to always know which session you are trading. New York session always comes with reversals. For example, if the market is coming down maybe on Asia session towards London session, maybe in New York might change the trend. You understand? Because they might not want to continue going down just like the previous two sessions have gone. You understand? So there is always changes in the market, and you have to always trade according to the time that all traders know the sessions they trade. You have to always check your schedule, check your time, know which time is very perfect for you to trade. You can choose to trade any of these three sessions. You can choose to trade 2 of the sessions. You can choose to trade 3 of the sessions. Me, I trade just on London session. But sometimes if I don't see a trade, or if I take a loss at London session, I might be done for the day. Or if it's a good day, for example, I might choose to trade in New York. But if I don't, I might just be done for the day, And I start trading my this thing at 8:15. So I trade only when the market is inside this place. That is my London session, So that is what happens here. So this is Asia session, this is London session, and this is New York session. And you can set it and trade at any of the times you want. You understand? Forex is all about sessions, all about discipline, and following your rules, and sticking to what you know. So sometimes in Asia session, when Asia opens, sometimes they create, like for example, Asia opens around. Look at the down part of this. Okay, I don't think it will be visible. Asia opens around this time, like what's my mouse? Around this place where I have my mouse, So, and it goes up, and it makes something like a high, which is like Asia. It makes an Asia high. So Asia all sessions makes their high and their low. For example, this is Asia high, like this is the high the Asia made for the day, and this, when London is opening, Asia has the lowest point it went for that day, so it is called an Asia low. You understand? So when the market opened at Asia, the market will calculate the highest point the Asia session went, and it will calculate the lowest point the Asia session made before London opens, so that it can probably go back to the highest point. The highest point that the Asia session could attain for when it opened is called the Asia high, and the lowest point it could attain is called the Asia low. Do you understand what I mean? So now, when London wants to open, it might probably want to go and take, and because there are some traders that, because of the highs and the low that each of the session, maybe because of Asia session, there are some traders that have their stop loss, maybe that are trading above the highs and the lows. So there are traders that based on my explanation, there are traders that trade the highs and the low of the sessions. So because the market know, and because the institutions know that there are people that have their maybe buying or selling, or have their stop losses above the Asia or the session highs, you understand, they usually go to take them out. You understand? So I'm trying to give you a literal kind of view, like the main foundation of what you have to know about just normal forex on the very literal meaning. You understand? So we've not started talking about the main this thing, but I'm just trying to give an overview of the market based on trying to choose your sentiments, or trying to know when you are going to trade or when you're not going to trade. So do you understand what I mean? Stella, do you understand what I mean? So you sure you understand what I mean? So I just chose to say this first, because to me it is one of the things you have to know, so that you would not be caught up unexpected, or so that at least you will know where I mean, like, first things first, before you are coming to candles and charts, at least first things first, so that yes, you might be learning and know when to trade, but you don't know that there are things that you have to check first. So these are just the normal first things to check first, and the foundation based on if you want to build yourself. Like I said, it's just discipline. So that is just it. So I hope. Okay. Yes. 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 Yeah. Yes. Yes, people trade news. People trade. There are traders. There are traders that trade news, and I think they are called fundamental traders. So there are people that trade news, but we don't trade news. We don't want to trade news, but we want the market to take the news to our setup. You understand? Because they use the news. What you just have to understand as a trader and as a smart money trader is that the market uses the news to you have your setup, so they use the news to go to your setup. For example, if you have a demand or supply setup, you understand, by your setup I mean supply or demand. you know so the market, if you have a supply or a demand, you understand, they can use the news to drive the market to that setup. Then a trader that knows will now take a trade. But if you're waiting to catch the direction of the market when the news comes out, there are people that do it, but I don't do it, and it is not advisable to trade when the news is coming out. So there are people that trade the news, fine, you understand, but we don't go close to the news. We stay out of the news and trade 15 minutes after the news. Yes. So that's what we do. So do you have any other question? And I want you to also understand that there are people that move the market. Like, there are people that move this market. You understand? We don't move market as there are people, there are institutions, there are people that move the market. You have to know that there are traders and investors that have the funds to move price, and price will go. Like, if they buy, you will see this thing. You understand? So that is what, just believe that yes, there are people that move the market first, then we'll come to that. You understand? So this is just the news, and this is what you have to pay attention to. Not reading the news to know the data, but just knowing when the news is coming, and for you to stay out of the news. You don't need the news for anything, you know. Yeah. Okay, non-farm payrolls. Yeah, it's also in every Friday. Yeah, every first Friday of the month. It's just something like employment type of statistics, stuff like that from the national. Yeah, yeah, it's also in news. Yes. So, but some traders don't believe in all those. It's just for those type of news are just news that comes out to the market so that they can use it and push the market to the place they want it to be. It's just for them to manipulate the market. That's just it. That is all this news. That is what they just use it to do. So yeah. So this is basically about sessions and all of that thing. So before no, no yes, but I don't use Asia. Yeah, but all of them are equal times. I just do it like this. Because I don't trade Asia. So I just trade London and sometimes New York, but basically London. So this place, I just trade inside this place. I can't trade outside of this place. So I just trade inside of this shaded part. So this is my London. So my setup can't be I can't trade when it is 8. I must trade when it is 8:15. So my setup must be inside the zone. That's So remember, this was just an example, telling you about support because the institutions were not around to hold the support again to buy from here. So this place became weak and it just dropped. It's just to tell you that they have the funds to do anything and they can do anything when they want to do anything. You understand? Yeah, yeah. So now you will be getting into business now. So um, so do we start from normal candlesticks um, or market structure? Uh, because I think this is an individual question. Because I don't know, Casey, I don't know if you are now good with candlesticks, and still I don't know if you are good with candlesticks. Like price action, like price action. Now price action, that is what is candlesticks. So I don't know how uh, how you know yeah, price action is just about candlesticks. Okay. Alright. So the candlesticks. So candlesticks has an opening, a low, a close, and a high. So each candlestick. Okay, let me just say. See, what you just have to know about this candlestick is just like before, back in the olden days, and back in the 1970s, 1960s, when there were no computers. You understand? Before you bought something or before you buy something, or before you buy a stock or a share or all those things, you have to go to the broker. You have to go to the brokerage company um, to buy a share. You understand? So there were traders that were interested in stocks and in shares, but because uh, if they wanted to buy, they have to go the the brokerage to buy. So now, and you have to call to brokerage to make your transaction and all of those things. But when the computer came in, they developed this type of candles. They developed candlesticks, like, and this means this represents what the traders, like those traders and those investors, that we are supposed to come or call the brokerage company to buy a share or to buy a stock. So this thing now is a representation of what other traders are doing. Do you understand? So now instead of calling a brokerage company or making calls and all of those things, you have candlesticks. So these candlesticks is just a graphical representation of what buyers and sellers are doing. You understand? So it's just a representation of what buyers and sellers are doing. And now, this graphical representation now that you are seeing now, it's just you can see that it has different types of shapes. You know, it has different types of shapes, and I want you to know that it is the institutions. Like it is, when I talk about institutions, I mean like the banks, the central bank, the reserve banks, like investment banks. You know, that is what I mean when I say institutions. They are the people that brought out the shape of these candlesticks. Do you understand what I mean? Like, because if you look at all these candlesticks, there are different types of the shapes. Not hugely different, but there are different types of candlesticks. And by the shapes, it's the institution that brought out the shapes. So now each of these shapes have a meaning. Each of the shape of these candles has a meaning, and it tells you what the market is doing or what is about to happen. You know, so the shape of these candlesticks helps you. That is what is called price action. That is price in action, something like that. You know, if the market is going up, you will see it from this action. It is just a price action. You know, so that is what I mean. That is just kind of a simple a simple kind of explanation that I would like to put up. You know, so each of these things has already been programmed. When I was reading about candlesticks before, back in London, and they said that, well, in the passage that I was reading, they said that the market was created with a game theory. They used a game theory to create the market, which is there must be losers and there must be gains in the market. There must be winners, yeah. So there must be losers and there must be people that are making profit. You understand? Something like that. So there must be wins and there must be losses. So that is just how it is. You know, that is, so now it is just money that just moves it. Just, you know, it is just money that moves it to any direction it wants to go. You know, something like that. Not something like that, but that is just it. You know, so now candlesticks. The first candlesticks that we are going to talk about is, let's talk about the let's talk about the Marabuzu first. So this is a Marabuzo. So this is the type of candle. Yes. So this is the type of candle that shows pressure. This is the type of candle that shows a selling pressure. You know. So each a candlestick has an open. It has a low. It has a high. And it has a close. So these are the things that a candlestick does. So a candlestick has a high, it has an open, it has an open, it has a high, it has a low, and it has a close. So this is just the shape. This is just a candlestick. So now the candlesticks open. A red candle always opens above, you know. So now it opens like this, and then buyers try to push it up here. Buyers try to push it up, you know. Then sellers said no, they want to push this price more downwards. They want to push this price more down. They don't want to buy, you know. So now the market starts coming down like this. So now the candlestick has showed you that, hey, see, the market came to this, made this, could attain this high. So it will show you from this candle that the market reached this high. So that is the wick. This is why you will get this place, you know. So now the sellers now started pushing the market down. To start keep coming down, keep coming down, keep coming down, and then reached here. And then the buyer stepped in a little bit more to know if they could push the price a little bit higher, and they now pushed the price here, and it closed here. You understand? So now it's made. So now this is the open. This is the high it could attain for this candle. Let me take out this. So this is the high it could attain, and it came down. This is the lowest point it made, and this is the close. Do you understand? So when this red candle opened, it made a high. The buyers pushed it up, but sellers continue pushing it down. Like it flipped from up to down. Continue pushing it down. And it came here, the buyers pushed it up here, and it closed here. So this is just the open, the high, the low, and the close. Do you understand? So now this is just for a red candle. Stella, okay, are you understanding what I mean by are you getting my explanation? Remember we trade. You already know our strategy, supply and demand. And for the most part, when we are, and I say that our setup can be a support or a supply or demand, you know. So at our zones, and if we have something like a demand or a supply setup, those we call it zones. Like if we mark a place, if we mark our zone, which is called if we mark our zone, let me just take something like this is something like let's say this is just a demand type of zone, you know. We always watch for price action when candlesticks are coming to our zones. For example, we always look for the shape of the candlesticks. It is usually the shape of the candlesticks that tells us what the market is about doing. So you always have to know your candlesticks. Do you understand? So I would actually like you to pay attention. So even after my explanation, if you have any articles you want to read, that's if you don't know, like if my distance, if you want to add more insight on candlesticks, you can also read, about candlesticks. So I'm just trying to tell you that candlesticks is one of the most important things that you use to trade, like trading supply and demand. You understand? Yeah. This is the high. This is the open. It's, so can you see the difference between the green candle and the red candle? The difference is just the opening, the low and the close. You understand? So red candle opens above and closes below, but green candle opens below and closes above. So this is the highest it could attain, then it closed here. So what just happened is it's opened, sellers pushed it down to this place, and buyers came to push it up, and then buyers started pushing it up, pushing it up, pushing it up, pushing it up. It came to this place. Sellers pushed down to this place, and it closed here. So it tells you the high, the lowest point it could attain, the highest point. So this is just the shape of a green Marabuzo candle. You understand? So this is one of the candles that you need to know about. So now we have another type of candle that is called the hammer. This is the most important type of candle that you need in your zones if you are trading supply and demand. So this is basically the most important type of candle you have to know about, the hammer. So this, when you get this type of candle in your zones, like in your demand zones, like when we start talking about demand zones, if you get this type of candle in your zones, it means a strong rejection. So this type of candle it's a reversal pattern type of candle. So you always have to, and you always want to spot this type of candles in your zones. It's just a reversal type of candle. Let me know if this Marabuzo, this red Marabuzo type of candle represents a bearish pressure. It represents bearish pressure. So but this one is a bullish pressure based on sentiment, market sentiment. So each time you see this is a bearish pressure and this is a bullish pressure. So the hammer, so when you are trading, always spot your hammer could be red or it could be green. So you can have anyone. So the color of the candle doesn't actually matter. So if you get this type of candles, this is a hammer. This is a hammer. This is one of the most important candles in trading. This is one of the most important candles in trading. So always be on the lookout for this type of candles in your zones. Yes, it is a reversal. No, it's not. Yeah. So I'm trying to, you can see each time you see this type of candles, you see a reversal. Each time you see this type of candle, you see a reversal. Let me look for more places that for example, here you could see the reversal. See here, you could see the reversal. Here you could see the reversal. So you have to, like, it is one of the most important candles in trading. You will see here the reversal. So you can always spot it in a downtrend. So if the market is coming down, you usually get it, then it reverses, then price reverses. So it's one of the important candles that you always have to, try to be on the watch out when you're trading. So we talked about now the Marabuzo, the hammer. Do you have any questions you want to ask me? Yes, it's just a normal candle. Sentiment, yes. It just shows who is more in control in the market. That is what it just shows. Who is more in control. Yeah. So now the second type of candle we are going to talk about, the third type of candle we are going to talk about is the inverted hammer. These are just the candles that you as a forex trader. So this it doesn't matter which color it is. So it doesn't matter which color. Yeah. So this is an inverted hammer. So this type of candle represents bearish rejection. It represents rejection. So it is telling you that no, the market wants to push down, and you usually see this type of candle in an uptrend. So for example, if the market is going up, if the market wants to come down, you'll start seeing these type of candles, which is telling you that it wants to push down. It wants to push down. So this is the type of candle you want to see on your supplies. And this is the type of candle you want to see on your demand. So are you getting me? This is the type of candles you want to see on a downtrend for a possible reversal. So this is the type of candle you want to see rejecting a level in an uptrend, which means they want to come down. They want to push the price down. And if the market is coming down, this is the type of candle you want to see. These are the type of candles you want to see in your demand. So another type of the third, the most okay, we've talked about this one. Then the fourth most important type of candle you need is called the doji. the doji. So this is a doji. Yeah, I think I'll have to leave it here, so I wouldn't want to change it. So this is a doji. I don't know if you will get confused if I label it here. Will you get confused? So the name of this candle is doji. Will you get confused if I label, since I had this one here? Okay, so this is a doji. This is just an indecision type of candle. So it's a 50-50 type of candle, so it's an indecision type of candle. So in your demand zones, you want to see these candles, these type of candles. These are the type of candles you want to see in your zones. This is a demand zone. This is a supply zone. In your demand, if you're getting these type of candles, we should, like, based on our own type of entry, we take our entry is usually at the break of the high of a candlestick. So if you're getting this type of candles, you should be taking, your entry should be always at the break of the candlestick, when we start talking about our entries. But basically, these are the candles that you want to see in your setup. Your setup can be your demand or your supply, but in a demand, these are the type of candles you want to see in your demand setup. Do you understand me? Okay. Yes. No, demand is not same thing as a support zone. I'm coming, I'll explain that. So, but remember, any of those, it doesn't matter which color it is. Do you understand? It doesn't matter which color it is. What matters is which action, which action are you saying? That is what matters. Like which of the action, which action by these candlesticks are you seeing on your zones? Stella, support and demand is not the same thing. For example, if I want to draw a support here, let's say there was no demand here, and I want to draw a support here. I can draw a support here, because the market was hitting this place, was rejecting, hitting this place, it was rejecting, just like this place. So this is a support. If we are trying to draw a support, this is a support, because a support must have, for a support to be valid, it must have at least 2 bounces. So it must have 1, 2. You understand? To have a valid support, you must have 1, 2. You understand? Then you might probably wait for a 3rd bounce. That's because now the support is valid. But we don't trade support and resistance. We just use support and resistance as references to trade our sentiments. Do you understand? So we don't trade support and resistance, but you can choose to trade support and resistance. So I'll make this. So, do you have any questions here? Okay, so, and you also want to see this bullish type of candles in your zones. Yeah. Okay, demand and no, yes, of course, yeah. We are still talking about. We just want to talk about the important candlesticks that you know, you know. But you ask your question, so I will know if I can use this candlestick to explain it. No, no, no. Demand is okay. I'll explain it shortly. But I have to make sure that you've understood this candlestick that I'm talking about, because before we before I talk about that thing, because it might actually be okay. I think I'll talk about it so that you understand then the meaning of you know. Okay, yeah, I'll talk about it. I'll talk about it. I'm coming. Um, okay, so um, these are the type of candles you want to see in your zones, your demand zones, and these are the type of candles you want to see in your supply zones. So this is a hammer, this is a marabuzo, this is a hammer, this is a doji. Yeah, so this is an inverted hammer, this is a marabuzo, this is an inverted hammer, this is a doji. These are just the candlesticks you have to know. You understand? And because the market makes a high, a low, a close, and a high, a low, open, high, low, and close. And all candles are usually supposed to have wicks. By wicks, I mean these things like the tiles. You know, so if in your maybe in your something like a demand zone, and you are getting this type of the the hammer has, yes, the hammer has a longer wick. Yeah, it means pressure too, like a buying pressure or buying reversal. So it means that the market was trying to push, like, or buyers are trying to push the price. you know so that is what it means. I'm trying to. So um this is another candle you have to watch out for in your zone, in your demand zone. Remember, this is a doji. So this type of candle, if you're getting this type of candle without a wick at the bottom, this could possibly do like this, flip like this and take you out, because the market has not made a lower wick. The market must, these are called wicks, like these tails are wicks. By wicks I mean like WICK. So these tails are wicks, you understand? So if on your demand zones you're getting a candle that doesn't have a wick, maybe it's still forming, or something, it has gone up, then it came down, and it maybe the market wants to make a low or a wick, it might just flip like this and take you out. So always be watchful if you're getting these type of candles without wicks on your zones. Do you understand? Casey, do you understand me? Yeah, so I just want you to just take notes of these candles. like take notes of these candles, because these are just the candles that you need. Yes, you can call it uh, um, no, 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 it's not a shooting star. You see shooting star in an uptrend. Yeah. I've forgotten the name. I've forgotten the name. I'll. No, no, it's not an inverted hammer. It's not an inverted hammer. It's not an inverted hammer. Maybe before we end the class, and I remember the name. So this type of candles, you don't want to see you don't want to see these candles in your supply zone, because it doesn't have a wick and it might just shoot up like this and take you out. See, it doesn't have a name. It's just a candle without a wick at the opposite side. It doesn't have a, it doesn't, because naturally a candle is supposed to have wicks. A candle is supposed to have a high and a low. Do you understand? So the market is supposed to have a high and a low, so you have to, it's not just it doesn't have a name. It's just a shape of it, just a price action that you have to know. you know yeah. So I want questions. Do you understand, and do you guys understand this? No, no, a bearish engulfing or a bullish engulfing is just what it just mean. Is just a marabuzo candle or another type of candle breaking the high and the low of the previous candle, of the first candle or the preceding candle. You understand? It's just breaking the high. Once it breaks the low and the high, it's just an engulfing. So that's just it. So, but these, if you're trading supply and demand strategy, these are just the type of candles that you need. So, supply and demand is basically demand is just an aggressive buying, and supply is just an aggressive selling. You know, yeah. So, supply or demand is just um, this will take me to waves. Well, I don't want to talk about waves. Um, Let me get this so I can use it. I'm trying to. So, um, so, I'll give a literal meaning of supply and demand. You understand? Like I just want to know if I can put it in the best, uh, like try to know if I can explain it very very simple. You understand? So, how am I going to? You know that to me, uh, supply like our strategy, supply and demand strategy is just a a theoretical type of trading, because you want to read meaning into what is happening in the market. But you want to read the mind of the market. You want to know the mind of the market. You understand? So to me, each trading or each setup I am about to take is, there is a story behind it, and the story has to make sense. You understand? It has to make sense, because if I call this a market, then that means it must have a buyer, it must have buyers and sellers. If it is a market, because what comprises of market, it is just buyers and sellers. Do you understand? So now, for every buyer there must be a seller. That is just how the market, that is just how market is. That if you go to a store, you are the buyer, and the person, the attendant or the person selling to you is the seller. So there must be buyers and sellers. So here there are buyers and sellers in this market. Remember, I told you that this is just the representation of what is happening in the market. These candlesticks you are seeing here are just people doing their businesses and doing their trading. You understand? And now I told you that I want you to know that it is institutions that move the markets. We are just coming to we are just coming to trade with them and trade with their flow. Do you understand me? So now, since we know that it is institutions that move the market, we don't know prior to their action. They have to make the movement first before we know. We don't know when they are going to buy or when they are going to sell. Are you understanding me? Yeah. So we don't know when they are going to buy or when they are going to sell, unless we are following market structure. So if we are following market structure, then probably we will know that yes, we are selling and we should be looking for supplies. So basically, when the market is breaking structure to the downside, we should be looking for supply setup. So when the market is breaking structure to the downside, which means the market is going down, we should just be looking for supply. So supply means that the market is just a place that has an abundance of sellers. That is what, because because when supply is too much, the price of something drops, and when it is in a huge demand, the price of the thing goes up. So the supply it just simply means it's a zone that where sellers are in dominance and waiting for the price to come. So when institutions, when they sell, when they make a sell or when they make a buy in the market, not everybody makes buys with them or sells with them at that time that they wanted to make that transaction. So now, let's say now, for example, something like the Reserve Bank of England wanted to put or buy maybe wanted to pump money into the market. Maybe they have about 50 billion pounds to push into the market. They are not going to push that 50 billion pounds into the market once. They are going to divide it into sections, and they are going to put it little by little so that they will not destabilize the normal station or the function of the market. So they have to divide it into parts. Do you understand? So when the institutions want to make a trade, they divide it into parts so that they don't make that big transaction boom inside the market, so that they will not destabilize the structure or the normal function of the market. Do you understand? So now when they make that movement, when they buy or they sell, one, they don't put all their money in it. Two, not all investors get buy or sell with them at that time they are making the transaction. So they usually buy and then or sell and then wait and then come back for more people to come and then buy with them. Do you understand what I mean? Do you understand what I mean? Yeah. So that is just the understanding of supply and demand. So now supply is just aggressive selling. which means, and demand is just aggressive buying. This is supply. The green, this green is not here, like this green and this red. For example, let me put this here. This green and this red, that is supply. This is supply. That is the green and the aggressive selling. Do you understand? So this is supply too. The green and the aggressive selling. So each place you see green and an aggressive selling, then that is a supply. Like here, the green and the aggressive selling, the green and the aggressive selling, and your selling must break a structure. Your selling must break a structure. Or your demand must break a structure. It must break a market structure. That means it must break a lower low. For you to have a valid supply, that supply must break a structure before you take the trade. If it doesn't break a structure, some traders do it, trade, but it is risky. Your supply must break a structure. So this green and this selling is supply. This green and this selling is supply. Look at this green and this red is selling. You can use 2 candles maximum. You can use 1 or 2. So at some point I might use, because the market is not perfect, so sometimes I use 1, sometimes I use 2, but the market likes to correct at its depend. I want you to know something. The market always wants to make a deep correction for it to continue going to the direction it was going to. But first, I want you to know that this is what is called a supply. This green and this red, aggressive selling. Do you understand what I mean by supply? The green and the red, that is what is called supply. That is what is called supply. You know, the green and the red, the green and the red, that is supply. And your supply must break structure. So when they sell, they usually come back up to get more investors in, so that they can sell. You know, let me find the supply sector here. Which one? Okay, we might get confused. This ones, I don't know the one you're talking about. This ones, this ones, I might get confused in searching the one you're talking about. But okay, this one. This one. Or this one. Okay, this one. Okay, yeah, 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 yeah. Yeah, it's news that usually makes this type of movement. It's news. Some news is usually too volatile, you know. So stay out from the news. Just stay out from the news. You don't need the news. Yeah, some people will tell you that they are smashing the news, but just stay out from the news. It's better to stay out from the news. I'm trying to get a supply set up. So like so this is like a supply. When they sell, that's aggressive selling. They come back up to fill the investors in so that they can sell again. Do you understand? So after your sell, it broke structure, then they came back up to get more investors in so that they can sell again. At this first movement, not everybody gets in at this first movement. They need to come back up to fill more investors in so that they can sell more. Do you understand? Yeah, so that is supply. That is supply. And then demand is just aggressive buying. Demand is just aggressive buying. Remember, in supply, I say the green and the red. That is the green and the aggressive selling. That is supply. The green and the aggressive selling. That is supply. But demand is the red and the aggressive buying. You wait for the market to come back, and then you watch out for the candles that we talked about, the candles that we discussed. That is the type of candles you want to see on your zones. By your zones, I mean either your demand or your supply zones. So this demand is just that they bought and not everybody gets in. So the market needs to come back to fill more investors in so that they can buy again. So these are demands. These are demand setup. These are demands. These are demands. These are demand. The red and the green. The red and the green. And remember, this type of strategy is a trending type of strategy. So when the market is trending, by trending I mean if the market is making higher highs and higher lows, or lower lows and lower highs. If the market is trending, it will always give you demand and supply setups. So, but they will not come to put more investors in all the time. But like for example, they came here and disrespected the zone. So anytime the first candle that is coming to hit the zone, that is touching the zone, is called a signal candle. It's called a signal candle. So that first candle that touches the zone, if any candle touches the lowest point of the zone, it makes it invalid. It means that they will not use the zone again. The zone might be respected, but it is invalid. That's if any candle touches the last end of the zone, it has disrespected the zone. Or supply, if any candle touches the upper parts of the supply here, it means that the zone has just the week. If it touches here, it has been disrespected. Remove it. It might not hold again. It will not hold again. Sometimes it does respect it, but it will not hold again. So this is a demand. Come back and buy. So now I need questions. I don't know if you guys actually understand. Though this is not a demand or a supply type of lecture, though, you understand. I think I'll basically call this something like a general overview, sort of this thing. But I need to know, like where and yes, yes. I don't think I would like to talk about supply and demand now, because it will get this thing. Yeah, yeah, yes, yes. So now the most important thing now is um uh let's say these candlesticks that we have talked about, you know, these candlesticks that you have talked about. So I would really love you guys to, like to study the candlesticks, open your chart and know where you see this type of candles, and see what action it was doing when you see it, So like I said, these are the type of candles you want to see on your demand, and this is the type of candles you want to see on the supply. So just study these candlesticks, and then you know come back with the questions you have for me. You understand? So, but if there's any other question based on this one right now, you know, because we are price action traders, though yes, we trade supply and demand, but from the action that the candlesticks are doing, we would know what the market is about doing. Yeah. So, is there any other questions? Okay. So, ST, um, which type of question I will ask you now? Which type of question will I ask you now? Well, I think I actually did. I think to me, I feel like it is clear. Like to me, I feel like it is clear. Yeah. So, so So, but this for now is the basic one. For now, like based on how we are doing it now, candlesticks to me, is for now the thing, so that we can start going. I think our next lecture should we could either be on market structure perhaps, so that because it is market structure is the I think after this candlesticks we should be going to market structure, because market structure is the key. Like without market structure there is nothing you are doing in the market. Just go back to your house and sit down, you know. But so that's just it. Yeah, because market structure it's just a studying the behavioral pattern of the market. Yeah. So yeah. Okay, okay. For example, after analyzing your trade, let's say you want to have a supply or this thing set up, a demand or a supply set up, you might actually want to, these are the things you might use to check the pips, check how many risks to reward you want to trade. So, yeah, so you use this to check your risk to reward ratio, you know, or you can use, there's a ruler on trading view that you can use to check how many pips you are covering. You know. So to me, how I trade now is I have a pip. You can use on your trading view. You see this a ruler. You can use it to check how many pips you are taking. in the market. So that's just what it means. So I think I'll call it a day here. Welcome, Stella.